7,800.
Wow. Say that again?
7,800. That's where Morgan Stanley thinks the S&P 500 is heading in the next 12 months.
That is a massive number.
It's huge. And just to set the stage here, we're in January 2026, entering the fourth year of this bull market. And for all the talk of recession, I mean, for what feels like forever,
It does.
the data is kind of screaming that we might just be getting a second wind.
That's a potential 14% upside from right now. I mean, it just flies in the face of all those doom and gloom headlines we saw last year.
It really does. But, before we go pop the champagne, we have to look at the nuance here. We've got a stack of reports in front of us that's honestly a little intimidating.
It is.
We're talking JP Morgan Global Research, Merrill Lynch, Fidelity, and some really deep dives on specific stocks. And the theme isn't just everything goes up. It's complicated.
Right. The rising tide is not lifting all boats this time around. This isn't 2021 where you could just throw a dart at a ticker symbol and make money.
And there's this phrase that keeps popping up in the reports, and I love this term, multi-dimensional polarization.
Sounds like a physics problem.
It does, like something from a sci-fi novel. But it's actually the perfect description of our economic reality for 2026.
It's the perfect description. You have these massive conflicting forces just slamming into each other.
Mm-hmm.
On one side, you've got this relentless AI investment cycle.
Right.
And on the other, you have a consumer base that is really, really feeling the pinch. It's the haves versus the have-nots.
So our mission for this deep dive is to cut through that noise. We need to figure out how you navigate a market that's broadening out, beyond just the big tech giants.
Exactly, because the playbook that worked in 2025, which was just buy the Mag 7 and call it a day, that might leave you totally exposed this year.
We're going to look at the enablers of AI. We're going to uncover this massive piece of tax legislation that's flying completely under the radar.
And we're going to dig into two specific value stocks that are kind of screaming, buy, while everyone else is looking the other way. The fixer-uppers of the S&P, if you will.
The fixer-uppers, I like that.
Yeah.
But okay, let's start with the elephant in the room. The AI supercycle. So 2025 was all about the chip makers, NVIDIA, AMD, the hardware guys.
Right.
But Fidelity is calling 2026 the year of the picks and shovels.
It's the classic evolution of a gold rush. First, everyone buys the gold. Then the smart money realizes, someone has to sell the actual pickaxes to the miners.
But in this context, the pickaxe isn't software, it's electricity.
It's power. It's the power crunch.
Yeah.
I was looking at the JP Morgan and Merrill reports, and the scale of this bottleneck is just startling.
So darling.
They noted that global electricity demand just grew by 4.3%. Now, that might sound small, but historically, that is a massive, massive spike.
It's huge, and it's almost entirely driven by data centers.
It is. Think about it this way. You can build the fastest chip in the world, have the most advanced cooling systems, but if you can't plug that facility into a grid that can actually sustain the load,
It's just a very expensive paperweight.
an incredibly expensive paperweight. And this isn't about plugging into a wall socket. We're talking baseload power. You can't just run a data center when the sun is shining.
Exactly, and this is where the whole narrative shifts from just tech to industrials and utilities.
For sure. I mean, we all love renewables. Wind and solar are fantastic, but they are intermittent. A data center needs 99.999% uptime. It needs power at 3 in the morning on a completely windless night.
So the solution isn't as simple as build more solar panels.
The solution, according to JP Morgan, is actually a renaissance in what you might call retro technology. Gas-fired turbines.
Burning natural gas. It feels like we're going backward, doesn't it?
I mean, in a way, yes,
Mm-hmm.
but it's the only way to get that immediate, reliable baseload capacity right now. So the whole investment thesis shifts. You stop looking just at the chip designer.
And you start looking at the boring industrial companies that build the turbines.
Or the utility company that actually delivers the power. It's the enablers trade, buying the companies that let the AI revolution actually happen.
But there's a psychological part to this spending, too, that really caught my eye. JP Morgan coined a term for it. FOBO.
Ah, yes, FOBO. Fear of being obsolete.
We all know FOMO, fear of missing out. That's greed.
Yeah.
But FOBO feels existential.
It is. And it explains why corporate spending on AI isn't slowing down, even if the economy wobbles. CEOs aren't spending billions on CapEx because they want the shiny new toy.
They're doing it because they're terrified.
They're terrified that if they don't, a competitor will use AI to put them out of business in 3 years. It's defensive spending.
Which creates a pretty high floor for the whole tech sector then. Even in a recession, you can't afford to cut that budget.
Precisely. It makes the whole AI trade much more resilient to a slowdown than I think people realize.
Speaking of slowdowns, let's pivot to the broader economy. That multidimensional polarization we mentioned, Merrill Lynch breaks this down as a K-shaped expansion, and I think this is really important for you to visualize.
It is crucial. Visualize the letter K. You have that vertical line, the recovery starts, then the arms split. The top arm goes up.
That's the asset owners.
Right. The top income brackets. If you own a home, your equity's up. Your stock portfolio is at all-time highs. You feel wealthy, so you keep spending. Travel, luxury goods, all of it.
But the bottom arm of that K is heading straight down.
That's right. Lower-income households, they don't have that cushion. They're likely renting, so they get hurt by rising housing prices. And they're dealing with what JP Morgan calls sticky inflation, around 3%. Their pandemic savings are long gone.
So you have this completely split reality. One group is booking flights to Europe, and the other is putting groceries back on the shelf at the checkout line.
Which makes the Fed's job an absolute nightmare. Do you cut rates to help the bottom leg?
Oh.
Or keep them high to stop the top leg from overheating everything?
It's a confusing picture. But there is one thing that might just boost corporate profits no matter what the consumer does. And I want to spend a minute on this because I had never even heard of it. We need to talk about the OBBA.
The One Big Beautiful Bill Act.
I still can't believe that's the real name. It sounds like something from a satirical TV show.
The branding is certainly unique, but if you look past the name, the mechanics are incredibly impactful. It was passed last summer, but the real fiscal injection is hitting now in 2026.
And JP Morgan Asset Management flagged this as a major tailwind. So break it down for us. What does this beautiful bill actually do?
Okay, so it's basically a corporate tax stimulus. It creates massive allowances for capital depreciation. So in plain English, if a company buys a $1 million robot, normally they have to deduct that cost over many, many years.
Right.
This bill lets them write off that cost much, much faster to lower their tax bill immediately.
So it's basically lowering the cost of buying all that AI infrastructure we were just talking about.
Exactly. It incentivizes the spend.
Yeah.
And the numbers here are staggering. It's expected to reduce corporate tax bills by $129 billion through 2026 and 2027.
$129 billion. That is just pure profit flowing directly to the bottom line of U.S. companies.
And here's the insight. Here's the thing most people are missing. Retail investors are obsessed with the Fed, right? They're watching every word from the chairman. But they're completely ignoring this fiscal stimulus.
It's a huge blind spot.
A huge one. And Morgan Stanley's bullish 7,800 target is largely based on this double-barreled boost. AI efficiency gains plus a massive tax cut.
So, okay, speaking of the Fed, the expectation is still for cuts, though, right? To sort of normalize.
Yeah, 2 or 3 cuts are priced in for 2026. But again, look at the polarization. While the U.S. cuts, Japan is doing the exact opposite.
They're hiking rates?
Finally seeing wage growth after decades of stagnation. The total divergence in global policy.
It is going to be a messy, complex year.
Which brings us to the so what. I mean, how do we actually play this?
Exactly. We've set the stage. AI power crunch, K-shaped economy, huge tax stimulus. Now let's get to the opportunities. We found 2 stocks in these reports that are, well, let's just call them unloved.
Unloved is being polite. They were hated in 2025.
Okay, so before we reveal the tickers and dive into the numbers, I just want to take a quick second to talk to you, the listener. We are literally parsing through thousands of pages of these dense financial reports.
And it's a lot of data to drown in, believe me.
So navigating 2026, it's going to be tricky. If you want to stay ahead of the curve without spending your weekends reading 10K filings, just hit that subscribe or follow button on the YouTube channel or your podcast app. It ensures you never miss a deep dive, and it really helps us keep the research flowing.
And let us know in the comments, are you seeing this K-shaped economy in your own life? We'd love to hear your take.
All right, let's get back to it. Segment 3, the fixer-uppers.
We're shifting our gaze from the high-flying tech darlings to the companies that really stumbled. And the first one is a giant, UnitedHealth Group, ticker UNH.
2025 was an absolute nightmare for them. If you held UNH, you were crying.
It was the perfect storm. They had that massive cyber attack on their Change healthcare unit, which paralyzed the entire U.S. healthcare system. They had DOJ probes, and then their CEO, Andrew Whitty, stepped down abruptly.
Investors just fled. So why are analysts saying buy now? Is this just a dead cat bound?
Yo, it's a fundamental turnaround story. First, stability. Stephen Hemsley is back in charge. He's the guy who built the company into a juggernaut in the first place. But the real catalyst, the thing that moves the needle, is the government reimbursement rate.
Or for Medicare Advantage.
Correct. For the last few years, the government was tightening the purse strings. But for 2026, the rate increase is set at 5.1%. That is the highest increase in a decade.
Wow. So the government is basically giving them a 5% raise on their biggest revenue stream.
Exactly. And because the stock was so beaten down, you can buy it cheap. It's trading at a PE ratio of around 17. Its 10-year average is closer to 22 or 23.
So you're getting a blue chip defensive stock at a nearly 25% discount, right as their cash flow is about to get a lot better.
It's a textbook quality value play. And if the economy does slow down, people don't stop going to the doctor. It's protection with upside.
Okay, stock number 2. This one is going to be more controversial because the market has just left it for dead. PayPal. Ticker PYPL.
The stock everyone loves to hate.
I mean, for years the narrative has been Apple Pay will kill them, Zelle will kill them. Just been called dead money. Why should we even look at it now?
Because of the math. The stock is currently priced for failure. It's trading at around 10 times forward earnings.
10 times for a tech company, that's basement level.
It's absurdly low. It implies the company is shrinking or dying. But when you look at the balance sheet, it's not. It's a cash machine.
And do they have a growth story? Or is it just, hey, we're not dead yet?
Well, the new management is finally executing on 2 key things. First, an advertising platform.
How does PayPal sell ads?
Think about the data they have. They know exactly what you buy when you buy it. They're building a high-margin ad network to monetize that transaction data. But the second piece is the AI integration. They just announced they are the first digital wallet integrated directly into OpenAI's ChatGPT.
Wait, hold on. So if I'm shopping through ChatGPT, using an AI agent to buy something, the default wallet is PayPal.
That's the integration. It positions them right in the center of the next generation of e-commerce.
That really counters the obsolescence argument pretty hard.
It does. The argument here isn't that PayPal needs to conquer the world. At 10 times earnings, they just need to stabilize. If they stop getting bad news, the stock just re-rates higher.
It's the low bar theory. They just have to step over a very low bar to impress people.
And the upside potential from these levels is really significant if they pull it off.
All right, let's zoom out for the final segment, commodities. JP Morgan Global Research dropped a number for gold that made my eyes pop.
I had to reread it. They are forecasting gold to hit $5,000 per ounce by Q4 of 2026.
That's a huge jump. What is driving that? Is it just inflation fears?
It's a combination of 2 really powerful forces. One, central bank buying. Countries like China and others are aggressively diversifying away from the U.S. dollar. They're buying gold by the ton.
Creating a permanent bid in the market.
And the second force is interest rates. As the Fed cuts, the opportunity cost of holding gold, which pays you nothing, goes down. It makes it more attractive than bonds.
And I saw silver is expected to ride that wave too, targeting $56 an ounce. But the metal that connects back to our whole AI conversation is copper.
The red metal. This is a supply and demand mismatch of epic proportions. You cannot build a data center without copper. You cannot upgrade the grid without copper.
And you can't just open a new copper mine overnight.
Nope. It takes 10 to 15 years. So you have demand going vertical because of the AI build-out, while supply is basically stuck. It's a classic price squeeze.
Before we wrap up, let's look internationally. We mentioned Japan. The report mentions a specific policy called Senanomics.
Yes, named after their new prime minister, Sanai Takaichi. It's all about aggressive corporate reform, forcing companies to unlock all that cash sitting on their balance sheets through dividends and buybacks.
And in Europe.
A darker theme, unfortunately. Defense. With geopolitical tensions rising, European nations are finally hitting that 2% of GDP spending target. That's a river of money flowing into European defense contractors.
So to recap, we have AI infrastructure plays, deep value plays in UNH and PayPal, precious metals, international reforms. It sounds like a candy store of opportunities.
It does. But we have to talk about the risks. We can't just put on rose-colored glasses.
The reality check.
JP Morgan assigns a 35% probability of a recession in 2026. That is not zero. That's more than a 1 in 3 chance the soft landing becomes a hard crash.
And inflation is the spoiler.
If that sticky inflation at 3% doesn't come down, the Fed might not be able to cut rates. And if they hold rates high, something in the economy could break.
And then there's the AI bubble question, the show me the money phase.
Exactly. Companies are spending trillions. If they don't start seeing massive profits from this soon, investors could get very impatient.
It's a lot to weigh. And obviously this brings us to our disclaimer. We're analyzing reports from third parties. Markets are volatile. Investing involves risk, including the loss of principal.
Please do your own research. These are outlooks, not guarantees.
But I want to leave you with one final thought from the JP Morgan Asset Management Report. They identify what they think is the biggest risk of 2026.
And it's not necessarily losing money. It's being offsides.
Being offsides. What do they mean by that?
It means clinging to the playbook that worked yesterday. If you're still 100% invested in the Mag 7, because that's what worked in 2025.
And the market rotates into healthcare and utilities and small cap value.
You're going to be left standing still while the rest of the market just sprints away from you.
So diversification isn't just a safety net anymore, it's the actual strategy.
Diversification is back with a vengeance. The market is moving, but the runners have changed lanes. You have to make sure you're not watching the wrong track.
That is a perfect place to leave it. Thanks for diving in with us.
Always a pleasure.